Exit strategies. See, it is this way. Venture capitalists are in the business of generating returns by investing in companies and hoping that their investments will appreciate in value in the future. This means that they do not plan on staying invested in a company forever. Once the venture capitalists see that the business they invested in has reached its full potential, or when they see that their investment may not have the desired upside remaining, they look to exit their investment, and that's where their exit strategies come into play. In short, exit strategies are plans that the venture capitalists use to sell their ownership under specific conditions. Venture capitalists prepare well thought out exit strategies for both optimistic and pessimistic scenarios depending on the nature of the investment they have made. Their strategies help them evaluate the potential risks associated with their investments, and accordingly, they can decide when and how to exit. A venture capitalist's exit strategy includes a liquidity event. So, what is a liquidity event? It refers to an action allowing a company's promoters and investors to fully or partially sell some of their ownership shares. Example of liquidity events include mergers, acquisitions, IPOs, etc. Commonly, venture capitalists rely on acquisitions or IPOs as the main ways to exit an investment and make a profit. Let's discuss the common exit techniques in detail. Initial public offering. This is a good choice for companies making $50 to $100 million annually. It involves making a portion of the company's shares available for the public to buy. The value of these shares can go up and down based on the market demand. Mergers and acquisitions. Often, companies that have received venture capital funding choose to get merged with or acquired by another company. This process involves complex activities like evaluating businesses and arranging the purchase of shares. Being acquired is usually an easier and cheaper way to exit compared to going public. Stock buybacks. This is a win-win exit strategy for both startups and venture capitalists. Sometimes, the founder believes the business can succeed on its own without external investors. In a stock buyback, the company repurchases shares from an angel investor or venture capitalist. This allows the investor to receive their money directly from the company rather than relying on new investors through an IPO or an acquisition. So these were some ways through which investors may look to exit from the companies they have invested in. In the next chapter, we look at how venture capitalists measure the success of their investments and calculate their return on investment.